just hit an all-time high on the Nifty 50. It's a historic day, 2nd of January 2026. We're at 26,329 and change. So it's a new high for us. It's a strong start to 2026. Can we last, Kunal, in terms of the levels now that open up for us? This has been critical. It's been a difficult ride again to get to this all-time high. And the last couple of all-time highs we've faced some difficulty. Do you believe that from here on, it's going to be smoother and sharper?
Yeah, it's going to be more smoother, more sharper. It's going to be more sustainable. And I think it's going to be more togetherness across various sectors and stocks. Because in 2025, it was hardly very few sectors which managed to move up higher. Mid caps and small caps, mids as we call them, they were underperforming. And very, very few select large cap names had actually shown signs of strength and recovery. And now I think we are getting into that point where there could be recovery across the board for individual sectors and underperforming stocks. We've seen IT stocks, metals, the PSU index, oil and gas space. There are so many stocks in so many spaces which are now looking very attractive. And this indicates that the market breadth has started to open up as well as sector trends have started to emerge. Now, these are two very classical signs which we look out for, because market breadth opening as well as the sector trend indicates that there is a new trend in the making for the benchmark indices.
Okay, so yes, that's the outlook on Nifty. Fireworks on the screen. 26,330 is where we are at now. We're being joined by Mr. A. Balasubramanian of ABSL AMC on the show. Mr. Balasubramanian, thanks for your time, and quick thoughts on what are you making of this move that we're seeing in Nifty, a fresh all-time high. Where are we headed from here now that we're looking at the Q3 earnings that are just around the corner?
Yeah, sure. Of course, at the beginning of the New Year's trend, of course, is quite positive. I think the way I see the market is evolving is the expectation of the earnings to get better. Post last year's GST cut and subsequent rate cut from RBI have been improving the overall expectations, rather increasing the overall expectations that earnings for the companies will get better, which now currently started reflecting. I think if you also look at the broad market, where we see the momentum is coming in largely on the basis of the, I would say, value-based buying, which is, of course, either driven by the earnings yield or the price have come down, but the asset remains very, very, very solid. There's therefore the few days momentum, largely driven by the asset-based, asset-backed companies are also being rewarded. That's where I think I see it coming in. I think it's more or less in line with the expectation that the current year the earnings improvement, I think, will take the market to a different level. I think that's what we are seeing actually in the market in terms of touching a new high.
Right. Hi, Mr. Balasubramanian. This is Harsh here. And give us some perspective. It's been a market where there have been different leaders in terms of sectors. Do you believe that sector churn likely to continue? For example, the metal sector has done very, very well for itself over the last year. Do you believe it's going to be a rotational market? Do you believe we're going to see a more broad-based market rally? Where do you see it, or how do you see it play out?
I think the way I see it playing out is, if you again look at 2025, there are a certain segment of the market did exceedingly well. It was more focused on a few sectors, including some of the new age companies. At the same time, some of the asset-backed companies, which a solid asset is there, but the stock was not performing. Therefore, some bit of sector rotation is happening. And second is, with these IT companies the last 5 years underperforming, we have been saying that maybe there could be a contract that will come. The balance sheets are strong. And once the tariff deal gets done and OpenAI issues something gets resolved, then there's a high probability the IT spending will go up. Therefore, IT sector will do well. Your metal also, we have actually put out an outlook for next year, should do well, purely on the basis of the capacity, which otherwise was very high in China, is now somewhat getting curtailed, and therefore the price stability is coming back. Therefore, the price stability driven earnings outlook is also getting better. Therefore, some element of sector rotation is happening. I think PSUs largely have underperformed last 1.5 years, despite some of the business in which they are in, they are very strong business presence that they have. Therefore, I would say the value-based buying could also come in the PSUs Also, an expectation the budget may give some kind of booster for the solid companies in terms of FDI investment coming in. These are some of the decisions if it comes as per the expectations. So that's naturally some bit of rotation of sectors would also play the role. I think what I see currently today is a more of value-based buying, some bit of sector rotation, purely on the basis of the relative value to the overall market is the one which is getting rewarded.
Okay, and Mr. Balasubramanian, lots of sectors to watch out for, like you just pointed out. But to scale that next fresh all-time high on the Nifty, if you had to bet on one big theme that could now lead the next market rally, what would that be?
Of course, largely we have been quite bullish on financial sectors, which includes NBFCs, and being the largest segment of the index component. I think that should drive. And second, even IT as a contra bet, we should see some kind of uptick coming in. As long as the results for the current quarter and the subsequent quarter guidance comes better than what they have been giving, then naturally some bit of pullback will come, could be driver of the market. And third is the energy sector also is quite bullish. There are three sectors which we believe that could be one of the driver of the market to the next level.
And Mr. Balasubramanian, what's the take with regard to broader markets, the Nifty mid-cap, small-cap? How are valuations looking to you out there? Is there some comfort which has started to creep in? And how much more of a consolidation do you expect over there?
I think our belief is, I think the large cap will continue to be the driver. As I just mentioned, some of the sectors largely driven by the large cap companies. I mean large and mid cap companies. Small cap, I think we should not look at the index because the index is a mix of many companies in their sectors. But I think it has to be more stock specific. I think earnings improvement definitely I think will come from across the board, given the fact that cost of capital for most of the companies have been now close to about single digit. And the large benefit of that I think will accrue to the mid-size and small-size companies. At the end of the day, that segment one cannot look at purely on the basis of 1.5 years kind of things. We have to look at beyond 2 to 3 years. Therefore, from a large underperformance that has come from the segment in the last 2.5 years, there is high probability that the outperformance could come from that indices compared to the Nifty Sensex indexes.
Okay, Mr. Balasubramanian, thank you so much for your time. Appreciate you joining us and wishing you and your team a very happy new year.
Thank you.
Thanks so much. Okay, let's get back to the market conversation. Fresh all-time high coming in on the Nifty. But Mr. Bagga, we had to interrupt you to address this development, but please continue to make that point that you were talking about, the exuberance that we're seeing in the market. You were also talking about the auto space. If you could tell us more about that.
Yeah, see, overall, the economy will do much better than last year. There is a pickup coming in. And there are triple boosters that the government has unleashed, income tax cuts, GST cuts, and RBI rate cuts. We are expecting more RBI rate cuts because they've handled the rupee depreciation quite well. And the pressure is off with the appreciation in the yuan. So the competitive pressure on the rupee is off, and that is creating space for the RBI to cut rates more. This quarter, the gone quarter, December, the banking results will not be that great. But going ahead, we are expecting those rate cuts to start boosting the economic momentum, and that will help the banking and financials to perform this year. So overall, this is looking a quite robust year for the Indian markets, and we are expecting nominal GDP to touch double digits again. The budget maths had factored in a 10% nominal GDP growth. We are nearer to 9% right now. We are expecting that next year we should touch that double digit nominal growth again. That then translates into 14-15% earnings growth for the key sectors. So we are expecting financials to lead this charge. Along with that, a lot of the power companies, energy companies, oil and gas should do well. IT, we are expecting with the US rate cuts, more space to be created for further orders. So you could see traction picking up in IT as well. Auto is leading the India consumption theme. I think that's a good way to play the India consumption theme through auto. Railways defense will again depend on the government infra spend. We are expecting the defense budget to go up. So defense stocks will probably rally into the budget on that anticipation.
And